Okay, class, let's go to the second half of the lecture on chapter 13, current. We're talking about current liabilities. And again, as I said in the last lecture, the classification between current and non-current is critical because investors or other users of the financial statement want to understand how much is the cash is going to go out in the next 12 months. Versus how much cash is going to come in with current assets, what's the status, financial status of the company. You might look at a cash flow statement. So what we have in current liabilities really matters. One of the big areas where companies can make mistakes is a bond payment may be out there. It's been in long-term debt. The example I like to use, let's say we had a 20-year bond payable. And so for years 1 through 19, that is in long-term debt. And whoever's doing the accounting, this is a real world example. They say, hey, long-term debt, year 1, year 2, year 3. Let's say someone had worked there a long time and you're getting into year 17 and 18 and 19, and then on day 1 of year 19, that long-term debt needs to move into current liabilities. But the person doing the accounting misses that. They said, this is how we've always done it. And someone maybe ask a question, is that still long-term? Yes, this is what we do. Credit, long-term debt, you don't touch it. Don't think about it. And so you could miss it. And that last year, in that 20th year, all of that bond needs to move from long-term debt into current liability. Usually we call it the current portion of long-term debt. This is very close to home for me because we had a serial bond that was out there, and it'd been out there, it was in long-term for quite a while, and we were doing the financial statements, I remember, for the second quarter, I don't remember which year, June, and there was a $25 million amount that was coming payable in the next June. So we're doing it as of June 30th, so that $25 million should have moved in from long-term into current. Well, we weren't thinking about it. We got 7-8 days to close out the books, finish everything up, package everything, get it up to the CFO, get ready to report. Auditors are in our hair looking at everything. We missed it. We missed it. There was $25 million that should have been in long-term debt, in current liability. They're still sitting in long-term debt. Now, it never got to the outside world because KPMG, our auditors, found it. Oh my God. That's not a fun story for anyone in accounting when your auditors catch something. And it was, I think, a young auditor, second, third year person. This could be you down the road here. And they were the heroes. They found this and they were very happy. Well, I was not too happy. My staff wasn't happy. Oh man, we really screwed this up, and we were laughing. We made KPMG look good, and we're not looking too good here. So, I had to actually talk to the audit committee about how that happened, and I apologized and said that was, my fault, and that we're going to fix this. And we put a process in place and controls in place that never ever happened again for my 11-year tenure as Chief Accounting Officer at Linux. And so, I always say you can make one mistake, but if you make 2, now it's a trend, and now people are going to be looking at you. So, but again, people got pretty excited about this because this matters. Being able to have the right classification as current. So here's the same example I was talking about. You had it was sitting in long term for 19 years, but in the 20th year, we've got to move it into current liability. So you have to scrub these financials and scrub the long-term debt every quarter if you're doing quarterly financial statements to make sure you're looking out 12 months. We would, for Linux, we would have absolutely caught that at year end. We had all kind of controls in place at December 31st to catch this, but we did quarterly financial statements that got reported to the Securities and Exchange Commission and to investors. And so June 30th, that was a challenge that we resolved and we fixed going forward. So that current and non-current. Now, there's nuances here, and I like to call this slide, this is like hardcore codification, look at the FASB rules, that there's all kind of nuances. Is something going to still be current, or is it going to have to be transitioned to current if we know we're going to refinance this debt? And so the FASB has some clear rules here. So if the debt is callable in the next year, even though the term might be longer than a year, but if the creditor, whoever we owe this money to, if they could call this debt in the next year, I got to move it into current. Because it could be, may not go, but it could be where I am forced to pay it in the next year because it's callable by the creditor. Now, if the creditor has a right to demand payment because of a debt covenant violation, okay, got to put it in current also, and it'll be a lot of disclosure. But if it's not yet callable within a year, if an existing violation is not corrected within it, so you have to look at these callable rules here very closely in the text, because you certainly could get an exam question about that. Then a second and complex area, I know that exams in the past have had this information on it. What if we're planning to refinance this loan? And so we have some rules that you unfortunately just have to memorize these because to understand it. So the firm must intend to refinance, and it must demonstrate the ability. These are the rules right from the codification, from the accounting rules, generally accepted accounting principles. But here is the issue. This is the principle base. The firm intends and it has a capability. However, in order to meet the requirements to keep the debt in long term, even though the written document says it has to be paid in the next 12 months, as long as you have a refinancing agreement signed by both parties prior to the issuance of the financial statements. No, that doesn't say prior to the date of the financial statements, prior to the issuance of the financial statement. For example, if our date of our balance sheet is December 31st, if we refinance prior to that, absolutely. We have an agreement in place, absolutely, that can stay long term. However, if we don't issue our financial statements, I would use Lennox again as an example, that a balance sheet as of 12/31, we didn't issue the financial statements until around February 20th, and when they were issued to the Securities and Exchange Commission. And so, so that is the date this is referring to. If you ever want to know the date of a financial statement, if you're looking at an annual report or something from a public company, go to the auditor's opinion. The date of the auditor's opinion, that is the date of the financial statements. In other words, auditors audit up through the date of the issuance of the financial statements, and they look at all transactions until that point. And so as long as this debt is, and you have a formal agreement to refinance it in place prior to the issuance, the formal issuance of the financial statement, therefore stays in long term. I do not have to bring it into current. Loss contingencies, again, another area that you will be tested on this in exam 1, in the final exam, on the CPA exam. This is a critical area. Why is it critical? Large amounts, really large amounts. An example that I'd like to use of a loss contingency is a heating and air conditioning product back at Lennox. But let me say this, loss contingencies always have an element of uncertainty. They're not clear cut. And so we're going to have to look at whether they're probable, reasonably plausible, remote, and can we estimate the amount? And so these are important things. And so the example I would use, we had a Lennox product, an air conditioner, that the supplier had put bad coating on it. And if this air conditioning unit was near salt water, then the outside would totally corrode, which doesn't happen in a normal. So you would look at this unit and all you would see would be a compressor. All the aluminum on the outside would be totally corroded, but it was only near salt air. Now, what we didn't know at the time, and it was hard to know, impossible to know early on, is how far do these units have to be to the ocean? Is that 1 block from the ocean? Is that 1 mile from the ocean? Is that 50 miles from the ocean? That's one thing we didn't know. Second thing we didn't know, where are our units? And so that was one. We knew it was probable that we were going to have claims, and we fixed every claim that came our way, but there was a time period where we couldn't estimate it. When we finally had done enough data to test it, and we started looking at claims around the country, then we did take a $25 million charge. And so, again, with these, we got to determine, is it probable the event's going to occur? Is it reasonably possible, or is it remote? The FASB does not give you percentages on this. The big 4 public accounting firms usually think of this as about 75%, and below 75% would be reasonably possible. And I think remote is something that's very, very unlikely to occur, and you'll kind of know that when you see it. And so here's the issue. When it's probable and you can estimate it, you have to record it. If it's probable and you cannot estimate it, you disclose it. And so for Linux, we disclose that issue in the footnotes to the financial statement, a whole footnote on loss contingencies. And we did not record it, but we disclosed it. It was probable, however, it was probable, but we could not reasonably estimate it. And when we were able to estimate it, we recorded a charge. If it's reasonably possible, disclosure. No, you do not record a journal entry if the item is reasonably possible. Again, stuff you have to memorize. If it's remote, you do nothing. So hopefully that's, again, something you're just going to have to memorize. You will see this on the exam. Now, a certain type of loss contingency is a warranty. So products are sold with warranties. The best example that I can think of would be automobiles, where they're sold with a 50,000 or 5-year warranty, so whichever comes first, and I'm sure you're aware of that. Even used cars sometimes will come shorter warranties, 3-month warranties. So a key point here, when does that warranty become a liability for the company? Let's think about it a minute. Let's say you graduate from here with your BSMS, you got this nice offer from one of the big 4 accounting firms, and you're out looking, let's just say, hey, like you're gonna get a BMW, like a 3 Series BMW, $40,000 car, 40,000. So that, I hope that happens for you. So the day you drive that car off the lot and you own the car, that's the day what happens at the BMW dealership. They record revenue, credit revenue, let's say it's 40,000, debit cash, they have your cash. So, or they got it from the bank because you borrowed it from the bank. They record revenue. Well, also that very same second, that same moment, you drove it off the lot, they owe you something. They owe you the service and repair and parts for every claim that you're going to experience until your car hits 50,000 miles or 5 years, whichever comes first. So that day, they need to record a liability. The day, right lined up on with the timing of recording revenue. Because that moment, they owe you that future service work. And so we're going to, on that moment, debit warranty expense and credit a warranty liability. How much do we credit? How much expense do we debit? We're going to estimate all the future claims we anticipate over that 5-year period, over that 50,000 mile period. How do we do that? We got a lot of data. We've sold a lot of BMWs. At Linux, we had a 10-year warranty on the compressors, and on some heating elements, we had a lifetime warranty on those. But we had a lot of data. We're an 80, 100-year-old company. We had a lot of data, even for the last 25 years, on how many claims we're going to have on every air conditioning unit we install. And so therefore, we can estimate all those future claims in debit warranty expense, credit warranty liability, right there on the data itself. And that is a loss contingency. And we'll have some basis. Here's an example of this. And supplier for in-home healthcare products. introduce a new therapeutic chair carrying a 2-year warranty against defects. Based on the industry, they believe that 3% of sales during the first 12 months and 4% of sales during next. So they expect to have warranty costs of 7% of their sales price. So the first entry, we know, debit, cash, or accounts receivable, $2 million, and credit revenue for $2 million. But they're also going to represent, they're going to have to go create warranty expense. Remember, 3% plus 4%, 7% of $2 million. They're, on the very day they sell that product, they incurred a warranty expense. And so they're going to debit warranty expense for $140,000 and credit warranty liability for $140,000. During the year, as they pay for this, and they actually perform service and have to use parts and supplies and service hours, labor hours, they're going to credit cash here, but they're not going to debit expense because they already debited expense in the first entry, right? That point, they're going to reduce the liability. So at 12/31, what does the company owe? They owe $140,000 estimated worth of future, satisfying future warranty claims for their customers. And as they pay those, they reduce the liability. Remember, credits increase liabilities, debits reduce liabilities. Now, over time, these estimates could be wrong, they're judgments, and you may come in and adjust the warranty reserve over time, the warranty liability, with the offset going to expense. So never perfect. I'm not going to talk about extended warranties. And then finally here, we have to have good disclosure of all of our loss contingencies. Explain, here's an example of one. I'll give you a minute to read that. And so they say it's reasonably possible that they're going to have these losses. So they have not recorded that, but they've disclosed that. And so you see a lot of disclosure here. Gain contingencies. So here's loss contingencies. If they're probable and they're reasonably estimatable, we record them. Debit expense, credit the liability. However, under the principle of conservatism in accounting, we never ever record a gain contingency. So we're never going to credit a gain in a receivable, debit receivable, for that. So loss contingencies we record only probable and reasonably estimatable, but gain contingencies are never recorded, even if they're probable, even if they're nearly certain. You don't record them. It's cash basis when you receive the cash. You could, if material, disclose in the notes to the financial statements. So finally, we do have withholding taxes here, payroll tax liabilities, and so we as a company withhold income taxes for our employees, and so we basically act as a collection agency for the government. So the government will get their money from us because the employee never receives it, and so payroll liabilities. And you can look at that part of the chapter there. And so we talked about that earlier. We would debit salary expense for the full amount of the salaries, and then credit cash for how much we paid. We'll have other credits in there for the various withholding liabilities, 401k that may go out to Fidelity or somewhere else, and in income tax withholdings that will go to state and federal government. So that's it for this chapter. Thank you very much. And so we will, I'll work some problems here next, and we'll move on. Thank you.